Okay, let's get this thing started. I want to welcome everybody. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I want to welcome you to today's presentation, Evaluating Market Rotation. We have one of the best here to help us in terms of trying to navigate what's been taking place in the market, what we think could be taking place as we go forward. So first, I want to introduce my good friend and creator of the RRG charts, Julius de Kempenaer. Julius, welcome.
Thank you very much, Tom.
Yeah, Julius and I were talking just a couple of days ago, and it's been a while, since you and I have gotten together and done a presentation like this. It's been way too long.
Exactly. Yeah. We had the Market Watchers live.
Yeah. Yeah, we used to do a show. Yeah, so Julius is referring to a show that we used to do on stock charts. It was their flagship middle of the day Market Watchers Live, and Julius used to come on that show quite a bit. And sometimes I think you even hosted it with me a couple times. But
that's true.
Yeah, always a good time. But yeah, it's great to have you here with us, Julius. Great to have everybody here. I just want to lay out a couple of ground rules. We'll probably go through, I don't know, maybe maybe three areas where Julius will be talking about a few things. Then I've got maybe one or two topics I'm going to cover, and then we'll have a Q&A session at the end. The event is being recorded, so if you do need to leave the room, whatever, you need to leave the webinar. We'll make sure everyone gets a copy. You can go back and review the event at your leisure. It is great to see everybody in here. We got a huge crowd. I've been mentioning the possibility we could reach capacity. So if you do leave and you can't get back in, just remember you will get a copy of the recording, but I would just not leave. Just kind of keep your seat and hang in there because the room is filling up very fast. But again, there will be a recording available for everyone, so don't worry about that. But let's go ahead and get started. Let's pull up the agenda for today. I feel like we'll probably go for about 90 minutes. Give or take a little bit. So if you can't stay around for the whole thing, that's no problem. But as you can see on your screen, we're going to go through the global equity markets. Julius does that quite frequently, and he's going to go through that with you with the RRGs. Cryptocurrencies. I saw Julius do this recently, looking at the cryptocurrencies. I thought it was brilliant. So I've asked him to take a look at those for you as well. And then he'll go into sector rotation. I'll take a little turn, go through some of the small caps, what I'm seeing there, because I've been seeing a lot of strength in small caps, and show you how I would consider using the RRG for small caps and trying to identify and zero in on some areas. And so obviously I'd love to get Julius' comments on that when I go through that. And then we'll wrap up the show with a Q&A. So if you have some questions for Julius, I'll try to get those answered. I'm sure we're going to have a ton. We don't want to be here all day, so I'll try to streamline them and put them together and organize them as best I can to try and get your questions answered. But with that, let's go ahead and get started. So again, welcome, Julius. Love to have you here with us today, and I'm really excited to see what you have to say about the market. But I'm going to let you go ahead and start. And you want to go ahead and start with the global equity markets?
Yeah, well, let's kick off with some international stuff. Let me grab the screen real quick here.
All right.
I want to continue, and I want to share my screen. So there you go. Now you should be able to see my screen.
Yep.
Right.
We got it.
Okay. So let's kick off with the international markets. I actually have that prepped here. There's in the drop down there's actually two groups that I'm looking at. One is international stock market indexes, and the other one is international ETFs. And there is a pretty good reason why I prefer to look at the indexes, and the reason is because these are quoted in their local currencies. And the ETFs are all ETFs traded in the US, quoted in US dollars. So when you only look at the ETFs, you will inherit the euro or the dollar versus the currency of the country exchange rate into your rotation. And that's usually not what you want. So I prefer to look at the underlying indexes, which is the chart that we're looking at right here. And once we find something that is interesting enough to dive in a little bit deeper, you can always go to the ETF, because the ETF, in my view, is the instrument to create exposure, not necessarily the market that you're looking at. Because For Americans, it may sound strange and impossible, but support and resistance and trends in, let's say, the DAX, which is the German index, is created on the Deutsche Börse in Frankfurt and not in the ETF on the New York Stock Exchange. So I hate to burst your bubble, guys, but there are other markets around and they do have their own trends and stuff. The good news is that you can play them using the ETFs quoted in US dollars. But the story here is the most important thing that I want you to understand is that when you work with an RRG, or basically with any charts analyzing markets that are not originally quoted in US dollars, please use the original currency or the original index to do your analysis. And once you want to get exposure to that market, go find a US quoted instrument that provides you with that exposure, knowing that you have a currency effect in that exposure. All right, so we got that out of the way. And what you're looking at right here is the RRG that lists a number of major international market indexes. And I'm using the DJW, that's the Dow Jones Global Index, as the benchmark for this universe. And if we quickly look at where the S&P is, you'll find the S&P inside the lagging quadrant, picking up a little bit of momentum. But if you look at the length of the tail on the S&P versus a number of the other tails, that's very short. And what that means in RRG land is that it is a stable trend and it's moving lower. So the S&P at the moment is underperforming the Dow Jones Global, is underperforming the world, and only picking up a little bit of momentum. But as you can see, it's still moving to the left. So even despite it's rising on the RS momentum scale, it's still dropping on the RS ratio scale. That means that it is losing, or the downtrend is increasing, but less fast. That's basically the message that we're getting here. And that short tail tells us that it is pretty stable. So there is not a lot of power behind it. It's just, like a little, not a wild river, but a river that's just streaming slowly and moving in that direction. In this case, it's going to the left, which is bad for US stocks. So in an international perspective, I'd be shy or underweight US stocks right now, to put things into an international perspective. Now, what other countries are we seeing that are worth our attention? The one that sort of immediately stands out for me is Hong Kong, because it is inside the improving quadrant and rapidly heading towards leading. So Hong Kong is definitely a market that I wanted to study a little bit better later on. Similar for China, SSEC. It is the weakest country on the RS ratio scale. So in this universe right now, SSEC, China is the weakest, but it is rapidly improving and it's pushing into improving. So this could be a very, very early call. So those of you who've listened me talk about RRG, you're probably aware of the fact that it is possible for these tails to rotate on one side of the chart. So inside improving, rotate back down into lagging. So stay on the left-hand side, continuing their underperformance, or in case of a very strong uptrend, rotate on the right-hand side and curl back upward. So this is a very, I don't know, speculative, very early call if you want to do anything with it. We'll have a look at that later. And then we have the Nikkei, which is right here, and the Bovespa and India. And you see that Russia, Kospi are rolling over, just like Mexico and Indonesia. Now, a good thing to do, or a good habit, is once you see something happening on the weekly RRG, which is what we're looking at right now, is to see if it is confirmed on a shorter term time frame. So in order to do that, we can look at the daily time frame and pick up those same rotations. And again, if we just quickly see where our home market, like the S&P, that just came back into lagging. So we had a short-term rotation from lagging through improving into leading, and it's now back into lagging. So the little improvement that we saw on that weekly RRG, where it was crawling up a little bit, seems to have come to an end, and that that little up move is what we see here on the daily. That improvement that's causing that up move on the weekly tail, and it's now back into lagging. So I would expect the S&P to continue further to the left and further into lagging in coming weeks. We grab that here and see where, because that Nikkei thing, that was the one that really stood out for me. Because remember that Nikkei was inside leading on the weekly, and here you see the reverse of what's happening with the S&P and some others. You see that the Nikkei actually rotated through leading, came into weakening, and is now curling back up. So we're inside the leading quadrant on the weekly RRG, and we rotated back into the leading quadrant on the daily RRG. So there's basically a double whammy. So it's coming, it's positive from basically from two angles. The other one, this is China. The other one was the Kospi, which was really good, but that's inside here. That was way to the right on the weekly, and you see that now inside lagging and rotating back up. The reason that I'm pointing this out is because that here, that tail on the Kospi. The Kospi is like, China is the weakest on the RS ratio scale. Korea is the strongest on the RS ratio scale. And there is a pretty good chance, just like for India, that this will roll over, maybe hit weakening, and then curl back up, because it is so far away from the center that the odds are pretty good for these trends to rotate back up. Then the next thing, and that's what I tell everybody who wants to use RRGs, it's better not used as a standalone system. I would never just make a call or make an investment just what I see on the RRG. I always want to just double check and go into the regular chart, into your regular workflow, to figure out whether what the RRG is telling you is actually confirmed on the chart. So the RRG for me is much more of an ID generator rather than a trading system or giving me trading rules. So starting with the Kospi, you can see, let me put that, make sure that you have, so we're looking at a weekly RRG. This is the weekly, yeah, this is the weekly. So you look at a weekly chart, so you can see what the difference is. And here you can see that break out of for Korea, out of that, it's almost just shy of a year. So big downtrend here. Then we moved in line with the world, with the Dow Jones Global, and we started to move higher somewhere in November. And actually the RRG, the RS ratio actually crossed above 100 in June. And we had some rotation on the right-hand side where the green drops below 100. And now they started to move and accelerated both, with RS ratio at a very high level, highest level in the last 3 years. And it's now topping a little bit. And that's what you see here. And that's what you see here in that loss of relative strength. That's what's bringing that tail lower. But you can see that there is plenty of room for that RS ratio line to actually, lose a little bit of value and then kick back up. So that's why I keep Korea on my radar. On the daily, you had a slightly different image. So here is the Kospi on the daily, and that's the sideways move here and the loss of relative strength here. That's what's being translated into that tail on the RRG. But bringing that all together, I would be looking to get to a new entry point for the Kospi. So if this comes down a little bit more, if we find some support here, if there is any price pattern that plays out, any other thing, maybe Tom has, Tom works a lot with moving averages and stuff. If you get some sort of short-term signal to get in, Korea would be one of the markets that I'm looking at. And we're talking way too long already on international markets. So I'm quickly going to go to the one that I like most right now, or two of them, which is the Nikkei and the Hang Seng. And you see that they are both here on the daily RRG rotating into leading or rotating back to leading. So if we bring that chart. Then this is the daily. Let's move to the weekly first, get the longer term picture. We have this super nice breakout here, that overhead resistance just above 24K. Stellar rise, but from an RRG point of view, which is relative strength, more importantly, we had this turnaround in this long, almost 3-year downtrend being picked up. And you see that in relative terms, it is only the beginning of a new move higher. We've already had a big rise. That's why it was on the weekly RRG. That tail for the Nikkei was rolling over. Let's highlight the Nikkei here. So it's rolling over a little bit. That's what you see on the weekly here. That's why you see this loss of momentum. That's the loss of momentum is barely visible here, but the RS momentum picks it up. That's why you see it rolling over here. And if we go to the daily, I'll make this a daily, then you can see that we're actually continuing this nice series of higher highs and higher lows. And in relative terms, we just popped above its previous high. So from relative perspective, this is a very interesting market to participate in. The ETF that you want to look at for this one is EWJ. It's the MSCI Japan from iShares. And you can see that the picture in terms of relative strength is quite different than what you had for the underlying index. Also, you can see that the chart is not as active. A chart like this with all these gaps usually suggests an illiquid market. Of course, the Japanese market is not illiquid. There is a difference in time zone, so you get gaps at the opening. When the US market opens, they got to adjust for what happened in the Japanese time zone. But it is a perfect instrument to actually play the Japanese market. Now, let's quickly move to the Hang Seng HSI. That is on the weekly RRG. That's right here, moving rapidly towards the leading quadrant. The ticker is $HSI. And what we see here is a nice pop above its previous high with a nice gap. So I think that's a super strong sign. Got a nice series of higher highs, higher lows. We've broken above some major levels of resistance in the past months, maybe even year. Let me update that. You can see here that this was a super important break level. So long term for Hong Kong looking seriously good. But look at the relative strength. You see that this is a nice rounding bottom. We're coming out of this relative downtrend. We digested all that negative stuff, and now we're starting to break out. And as you can see on this, that turnaround is just about to begin. It's just about beginning. Combine that with a break of a very important overhead resistance level, I think that makes for a super strong market, especially if you zoom in on the RRG, where the tail on the Hang Seng is actually confirming the strength that you see on that weekly and that you see here. So basically, wrapping it all up, of course, if you're a US-based investor, the S&P is super important. We haven't spoken about asset allocation, but if you do the comparison between stocks and bonds, stocks are still, flying colors over bonds, no problem at all. Overweight stocks is the way to go. If you have an international part in your portfolio, if you want to bring an international part in your portfolio, I suggest to take a look at, let's say, the Asian markets, Hong Kong, Nikkei, maybe Korea. And if you're very, very bold, then maybe to even look at China. I haven't looked at that. Let me do it right now. This is a little bit of a surprise what we see here. Oh, well, that's actually pretty nice. So you see that's breaking to new highs there. So it could be a very bold call, but this, as a matter of fact, to me, that doesn't look very bad. We do need a little bit more on the relative strength area, because that is probably why we're still on the left-hand side of the RRG, because, yeah, that's still pretty much in a downtrend, and that's, So short term, if you like that, maybe Tom, you want to make a comment on a break like this on that market. But for me, it's a very bold and early call. I like Hang Seng and Nikkei a little bit better because they're a little bit more mature relative uptrends.
Yeah. And I don't know how you feel about this. I'm going to make a comment and you can tell me whether you agree with it. But when I look at the RRGs and I look at the vertical scale, which is your momentum, and then I look at the horizontal scale, which is relative strength, for me personally, I'm more interested in that relative strength from a more longer term, big picture kind of look.
Yep.
Because sometimes you'll get that momentum thrust on the left side of the chart and it, never quite makes it to the leading and turns back down again. So
Yep.
I always like those areas that have been leading and then maybe even pulling back into the weakening and starting to turn back up again. I think that's the Hang Seng that
Yep. Hang Seng
you
and
have.
the Nikkei went through the same.
Yep. So that's really what I like to see is over on that right side. I like to see that rotation, just like you're
Yep.
showing there. Hang Seng goes down into weakening and then rolls back up. From a
Yep.
longer term investor, I like seeing that kind of action. I mean, when I say longer term investor, longer term picture. Like if I'm looking to see which ones would be most interest to me, that's what I would focus on would be a horizontal.
Yeah,
But
agree. Yeah,
if I was short, go
yeah,
ahead.
go on. Well, the RS ratio is the most important one. That's for sure. That's the main indicator.
Okay.
And the whole we won't go in the whole story of RRG, but that was the first indicator that that I developed. That was the first part of RRG, if you want to. And I used that for a long time to basically rank a universe based on relative strength. That was the RS ratio line. And RS momentum came later to when the desire started to exist to be able to make a little bit earlier call. That's when momentum came in. So yes, you're right. And that's what we've been studying and researching, that these rotations that go from leading to weakening back into leading, I think the best way to describe it is that they are more reliable. Because when you move from improving into leading, that's the turnaround. That's when that downtrend turns around into an uptrend, and sometimes those turnarounds don't work, and you rapidly get back into that downtrend with a very short stint through leading, and then it starts to drop immediately. I wasn't going to say that's happening all the time, but it happens more often than you would like. And when you see that rotation, because this is when it turns around, if we look at where the Nikkei and the Hang Seng went, let's pick the Nikkei, where is it? Here. So it moves in. So this is where it's actually turning from a relative downtrend to a relative uptrend. And then it goes into that initial new phase of that initial relative uptrend, starts to lose. This is where it's going into its first pause, and then it comes back up, and then it's going into the second phase of that new uptrend, and that usually is much more reliable than the initial entry phase.
Right. Yep. All right. There was one question that came up too. And I don't know if, well, I'll let you answer it. Do you have a timeline when you'd expect a full rotation? What would you consider, I guess, as a full rotation? And is there a timeline that you look for?
You mean the amount of time that it takes to make a full rotation?
Yeah, I'm thinking like the questions like how have you seen, areas or, whether it's sectors or whatever, just kind of go through all four quadrants? I mean, is this something that when
Yeah, I
I
have. Yeah,
I
it's okay. So they always rotate clockwise. The rotation is always clockwise. And I'm going to say, even if it doesn't look as if it's clockwise, it still is clockwise. Because sometimes you have these hooks on the weeklies, but when you zoom into the shorter term time frame, you'll see that the rotation is clockwise, but it was just too fast to be picked up by the weekly time frame. Now, I don't have an estimate on how long a full rotation would take, and I've seen many different variations. Some go very fast, some go take very long time. I don't think there is of course you can calculate an average, but I don't think that's very useful. You just have to let the market tell it to you, let the market tell its story. because I wouldn't feel very comfortable, I guess, with saying, okay, so you've now spent 6 months on the right-hand side of that graph. It's time for you to move over left, or vice versa. If you look at stocks like Apple, or maybe all the textile or the technology sector, they spend ages on one side. Or energy. I think you and I discussed energy the other day when we were having our chat. You know, energy was on the left-hand side of the RRG forever. So I don't know whether that would be a good metric. What I do know is when I use this, when I started using this in my research for my institutional clients, my sort of rule of thumb for a trend change, because I was making calls for stocks and sectors saying, I think it's an outperformer, it's an underperformer, or it's neutral. Those were the only 3 calls that I could make. And what I would tell them as a rule of thumb is that when I change from one to another, that new trend, usually ballpark figure, remains in place for at least 3 months. But I've seen those trends last for much longer. And then I've also seen them that, last much shorter, but these are the shorter ones, I think, are the exceptions, where the longer ones are more the rule. And the reason that I did that for them is because these guys, they don't want to be told this week to buy Japan and next week to sell Japan, because they've got very large portfolios. They may need 1, 2, 3 weeks to even build up the portfolio to the level that they want. So on a weekly RRG, I use about 3 months as my rule of thumb. And if you translate that to daily, that would translate to roughly 3 weeks of a trend. But again, shorter than that is the exception, longer than that is the rule. And the only thing you have to do is just look at these raw, I call these raw relative strength lines, just the relative strength of the relationship that we're trying to capture. These trends, this is a 3-year downtrend. Whereas we had in price, we had a 2-year uptrend and a 1-year downtrend. But relative to the S&P 500, it's a 3-year downtrend. So it's just, what is your interest? If you're an international investor and you want to beat the global index, then China was none of your business from 2016 to the end of 2018. And pretty much it wasn't even your business because it didn't really work. Still, you're very early here, so there's much more out there that's more interesting. So that's the way I look at it.
Okay, yeah, it makes sense. All right, well, why don't we move on to the cryptos, because I found this to be absolutely fascinating. You wrote an article in your blog not too long ago, and I thought your look at cryptos was as good as anything I've seen. So why don't you describe what you do there?
Yeah, cryptos is an interesting it's an interesting beast. First of all, I am not a crypto nerd or something like that. It's not that I have a very strong feeling that it is the next gold, nor do I think that it is a useless investment. You got the economists that say it represents no value. You got the Bitcoin fanatics that say it's the next gold or something like that. I look at it as a market, and a market that is traded. And what fascinates me in crypto is that the rules of technical analysis, basically fear and greed of mass psychology, works so well because it's unregulated. There's no companies. There's hardly any regulation. It's more or less pure supply and demand, and that's what I like about it. So I started playing around with it and started throwing some cryptocurrencies at an RRG. And you can actually do that in a couple of different ways. Let's as a quick introduction, let's look at the currency RRG. So you have an RRG of currencies, and here you see the G10 currencies expressed in the US dollar, or G9 against the US dollar. Together that's 10. And you can see the rotation of these currencies versus the US dollar. And you can see that they move more or less in tandem. You see what I meant? Remember when we talked about the Nikkei and the currency effect? Look at that. That's the currency effect of the US dollar versus the yen. So the yen is now losing value against the dollar. So when you invest in Japan and you take the you buy the ETF, you are actually buying yen in dollars. So that's a negative effect in the performance of your ETF, just so you know. So that's the way we look at currencies. Now you can do the same with cryptos. So the next chart is cryptos with the US dollar as the base. So here you look at all the cryptocurrencies, or all a selection of the most important cryptocurrencies, and the US dollar here is the base of that chart. So you look at the strength of crypto versus US dollar on a weekly scale. And they've pretty much all been beating the US dollar, which is not a surprise. That is what we know. And you can actually look at the stellar returns here over the last 5 weeks. So Binance Coin up almost 200%, IOTA 170, Cardano 120, etc., etc., etc. They all beat the US dollar as an investment. Basically, this chart tells you that you would have been better off over the last 5 weeks to own any of these cryptos versus owning cash US dollars. Don't start about the risk, because that is obviously just as big as that. But that's the message that this RRG is sending you. We can do that on a daily basis as well, and you get the same picture. So even over the 5 days, look at it, 140% in 5 trading days. These numbers are absolutely crazy. And I had to get used to actually, I don't know, sort of forget about these numbers, just look at the trends and forget about these numbers, because they go up and down. You know, it's a wild market, and I would never advise anyone to do that for their long-term pension plans or stuff. But if you're willing to take a gamble and are able to handle the associated risks, then for sure this is an interesting market. The problem with this is that they're all interesting. And then I thought, you know what, if you express these cryptos versus the US dollar, that's one big pack. That's not really relative. Now, for me, you can actually capture the whole crypto space by Bitcoin. So I think that it's safe to say that Bitcoin is the benchmark for cryptocurrencies, just like maybe SPY is the benchmark for stocks or stock sectors. So the next thing we do is we actually run that RRG, but now we bring Bitcoin in as the base. And now you can see a more pronounced picture and a more granular picture. And then you see that Bitcoin was very strong. It was not the strongest of the pack. And you can actually see that if you look at the 5-week performances. Bitcoin actually comes in pretty late. So you got all this stuff that is moving. They're pretty much all moving in northeastern direction here. But this is a very wild thing. That is, you got to be careful with that. And this is picking up a little bit, but they're all over the last 5 weeks. They've been beating Bitcoin in terms of performance. Only these are going down. So what this tells me is that there's a whole bunch of cryptos that are more interesting to play and to invest in than Bitcoin. And again, we'll do this on the weekly basis first. And the ones that I really like, for example, the one that really stands out for me is Cardano, because it is on a very nice long tail. It's very quiet. It's gradual, powering into the leading quadrant at that strong RRG heading that we like to see. That is that northeastern direction. So ADA is one that I really like and I keep my eye on. And then we have that Binance coin, which is super strong again. So this is how I look at the crypto space, and we can do that on a daily scale as well. And then obviously, so here is that Binance again. You see that this is one of the images where you can see that that hook. And unfortunately, it's the daily. But if we were to look at BNB versus US dollar on an RRG that shows maybe 4 hours or 2-hour time frames, you would see a rotation in a clockwise fashion that will, pick up the rotation in this hook back up. let's see where we can find that. That one was there, and you can see the shorter term ones. So these are now at a shorter term basis interesting. Here you got Cardano, which was the strongest one on the weekly RRG, but it's now rolling over into weakening. So it's going through some sort of a pause or a hesitation. And that's how you can look at those cryptos. If we look at the ADA chart, full disclosure, I do own some of that stuff, just as a little gamble. But it behaves very nicely, and you can see that break out of that. Some of these cryptos have been doing nothing for years, and then all of a sudden they break and they rise massively. And you see what I mean by respecting your old levels. Look at this. This is around 40 cents. That is 2021, and here you got it in 2018. So that's 3 years ago. The high was 38.8. Or yeah, 38.8, and here the high is 39.7. I say that is a pretty nice match of resistance, and you see the hesitation before it actually breaks higher. You also see the very pronounced respect for old lows and highs, which I'm not sure about you, Tom, but I find this fascinating that these coins, which represent something, or if some say they represent nothing, they will respect the old highs and lows that we as investors in that stuff have been putting into place. And this one on the daily, you can see, and what I like here is that this actually looks like a little flag pattern that we broke out from moving higher. Yeah, that's how I look at cryptos, and trying to break it down to just not look just at Bitcoin, because that's pretty much the world is eyeing, but there are coins that are from time to time more interesting to play than Bitcoin itself.
Yeah, what bothers me when I look at something like this, Julius, is just, it's almost like a parabolic move, and we saw a few years ago where it made
Yep.
one of those similar moves, and the next thing you know, it's back down to zero. I don't want to be in when I don't want to be getting in when it's near the top. You know what I mean?
Absolutely. That's why it's so tricky to new high 53.5 as we speak. That is,
Yeah, it's crazy.
you need to
No,
actually look at it at a log scale, because otherwise it makes no sense at all.
don't you feel though, when you've got companies like MicroStrategy that are buying, Bitcoin as kind of their currency or whatever, and then you've got Tesla saying, hey, we're going to put what was 1.5 billion or something into.
1.5 billion, yeah.
I mean, to me, that gives Bitcoin a lot more credence, if you will, than, where it was just a bunch of individual folks jumping in and jumping out.
Oh,
When you get
sure.
the
That's
putting that kind of money in, that has to make you feel a little bit better about it being a real thing.
absolutely, and I think that's the big difference. If you look at Bitcoin rally now, let me make this a little bit longer. Oh, the history doesn't go back here too much, but yeah, I think that if you look at the rally here from 2015 to 2018, these were the pioneers. These were pretty much all retail. Maybe the odd institution that was just dabbling with very low percentage of their assets going into that space. I think even a couple of the big banks, like Diamond from JP Morgan, said it's useless, and BlackRock said it wasn't anything worth looking at, and I don't know. There's a lot of people who said it was nothing, and then you peak at 20K in 2017, and then nothing happens for 3 years. Well, nothing happens. It just sinks 50%, probably like that, or maybe even more. So I mean, here it was all over the news wires, and then it wasn't in the news wires for 3 years, and then when it broke 20K, it started to get back into the news wires, and then we double in a couple of weeks' time. I think that exactly what you say is that this rally here has a lot more professional and corporate participation than here. And one of the other things that I think is important, that over this period of time, slowly but surely, more governments and more regulators are trying or have put regulations in place around Bitcoin and other cryptocurrencies. As a matter of fact, I still needed to do my taxes. And I was working at that earlier today, and I noticed that on the form now is a question whether you own cryptocurrencies, i.e. Bitcoin or others. So the Dutch tax man actually wants to know whether I own cryptocurrencies.
That's pretty funny. One question that came in, maybe this would be a good way to finalize a segment. I think you had done this before in your article, but there was a question came in and said you can compare cryptos with the GBTC. And I thought that you had a chart up where you were showing Ethereum and one other one.
You mean this?
You know what I'm talking about?
No, well, this is GBTC. So here, the Grayscale Bitcoin Trust. That's an ETF, right?
Yeah.
Yeah. So here you got that same group of cryptos, but now the benchmark is GBTC.
Okay.
So that does that look even remotely?
Maybe you had a different benchmark. I'm thinking back to your article where you pointed out, I think it was Ethereum and Cardano
Oh,
that
yeah.
looked better.
That was no. That was the chart that we've been talking about, but that's a while. Well,
Put that one back up again. Maybe because I
I
had gone to the
think
side.
because
Yeah.
that was here because it was
Okay.
Ethereum
Yeah.
and ADA. This one here.
Yes.
I think here, something like this, because here you see Ethereum moving
Yeah.
into, and ADA at the time we're moving into leading. This one was just about there. So this is in February, start of
Yeah.
February.
Yes.
That's how it looked. So if you look at Ethereum, see how that did. Well, it's still there. So you know, ADA and Ethereum are still the two that are, I think, on the weekly scale, the most promising ones, rapidly followed by Binance Coin. But you look at these percentages. That's absolutely crazy. I mean, look at BNB, so BNB USD. Oh, that's not going to work. This one, yeah, I need this one. Yeah, I have trouble following this. It's maybe we have just to admit that we are now too late to the game. Although this is a bloody nice pennant. This
Yeah.
is what Edwards and McGee described as a pennant.
Yeah.
And I mean, this is one of my things. When you go on Twitter or Facebook or wherever, or even professional commentators, some of these people they wanna call head and shoulders pennants, wedges, triangles everywhere.
Yeah.
Where I'm sort of old school and pure, and patterns more often do not occur than they occur. Just
Right.
don't try to see a head and shoulders in every triple top. Don't try to see a pennant in everything that moves a little bit of sideways. Or people are
Right.
watching pennants that take 6 months to form. That's not a pennant.
Right.
People are calling a triangle with two lines that are converging at different angles a wedge. It's not a wedge. It drives me completely nuts that everybody calls everything everything. But just for you and me and everybody who's listening, this is a proper pennant. Not a
Yeah.
flag, it's a pennant, because it's little like what you have on the ship, or when your birthday is and you have flags up in the air. That's a
Well, yeah, and
pennant.
these are continuation patterns. So a lot of
They
times
are.
I see folks trying to put these patterns in the middle of something that's not even a pattern. You don't even have a trend.
Yeah, there's no, yeah. So here you got that very nice flagpole, and this is beautiful.
Yeah.
We need to save this one, because this is absolutely textbook, and that's why it's so cool, because this is people making a market. This is people. This is not influenced by market makers, by big companies, by stimulus packages, by God knows what. Yeah, very cool
Well,
to
the
see.
downside, the one thing I'll say about the downside to that, though, without having the market makers, is that literally, when you're buying, if there are no sellers, prices just go straight up. I mean, you don't have anybody providing liquidity in the market. So
Exactly.
that's why we see these big moves in both directions. And so there's positive and a negative, I guess, to
Yep.
having the market makers or not having the market makers. You know what I mean?
I 100% agree. But that's also why support and resistance works so well in these markets. But you're right. I mean, it's like, to a degree, it's probably comparable with small caps in stocks where there is just less liquidity. So when you got a massive demand and there is very little or no supply, you can get these big moves because that demand wants that stuff, and the sellers only want to sell at a higher price point. And that's what you see in cryptos as well. Cryptos, let's face it, it's still a very immature market. There's very little regulation. There is, despite the fact that it's becoming more and more popular, the complete market capitalization of the whole crypto space is just a drop in the ocean when you compare it to the bond market or the stock market. So, we're not nearly to the maturity in terms of market and market behavior as what we see in bond and stock markets that are around for hundreds of years.
Yeah. Well, I got a comment here from a friend of ours, Julius, who's also portfolio manager, CB3.
All right.
Um, yeah, and
Hey, Charles.
he's going to give us. He gave us a couple comments on this, and he said his thoughts are: number one, if you are not long cryptos, you're short cryptos, which is kind of an interesting. It's a pretty interesting statement. I like that. And
Yeah.
then the second thought is cryptos are establishing their worth as an asset class, thus they are trading on fundamentals, not on technicals. So something to give some thought to. But Julius,
Yeah. Yeah. Although I agree. The only thing is with fundamentals, I'm not sure. I'm still trying to figure out what the fundamentals for cryptos are. I mean, for Bitcoin, I think the fundamentals are the amount of supply of coins that's coming to the market and the halving and the way they're mined. And I think that's like, mining of all these coins have to be mined. So I think that is sort of if you want to capture fundamentals for cryptocurrencies, that's maybe what people look at. And definitely for Bitcoin. For the other coins that are like Ethereum or Cardano that are projects on the blockchain, there's usually a project or Ripple, XRP, sort of settlement coin where people can future payments or security delivery versus payment type system type things. Those could be fundamentals for crypto, but it's very, I think in my view, it's very limited actually. I do like the notion that if you're not long cryptos, you're short cryptos. I'm just wondering whether that also means that if you're not long stocks, are you also short stocks?
well, I think it's the opportunity cost. I don't, you're not
Yeah,
literally short. You're not
yeah.
losing money, but
No,
you're losing the opportunity to make more money. I think
yeah,
that's
it's an
which I think is pretty
opportunity loss maybe. Yeah, for
correct.
sure. Yeah, yeah, it's true. Let me just one little thing I want to try here, because one of the things that I look at very often, because he says establishing their worth as an asset class, and I thought about that recently. Let's just stick dollar BTC USD. So this is my RRG that I use for asset allocation. Just the only thing that I'm afraid of is that, yeah, there you go. It pushes everything else away. So crypto is, it's losing a little bit of value, strongest asset class of the whole thing. And it's that, well, for a while already. Look at that. Okay, so here. So when did that move? This is May 2020. So from May 2020 onwards, you probably would have been better off holding Bitcoin than. You see, we talked about those rotations on the right-hand side. And you said you liked the stuff that was inside leading and curling back up. You see here is hooking, but on the daily, I bet you that it's rotating clockwise. It's going there. Here you go. Now we go back up. and now we're rolling over, and we're there. So this, yeah, I mean, Charles is right. I mean, and that's why the profession, there's definitely more professional interest in crypto and Bitcoin, and this is probably what is displaying that. So there you go.
Yeah. All right. Well, let's go ahead and move on, because I want you to go through the sectors. I want to see what your thoughts are on the various sectors versus, I guess, the S&P 500 or whatever benchmark you
Yeah,
want to use.
yeah, I use sectors I use versus the S&P 500. So here's the RRG showing the current rotation for various sectors. The one that stands out is for energy, and I've been sort of caught off guard with this one because I didn't really expect the energy sector to make that move all the way to the left. If I bring up, here's energy. I mean, here's that long-term downtrend in the energy sector. It's like more than 3 years now, almost 4, and we're coming out of it. And so this is the initial move, and I thought we would be rolling back into lagging when that started happening, because you see that it started here as by far the weakest sector back in November, and it started to pick up with a lot of momentum, and it was still at this point in time the weakest sector, and then it started to, and I thought it was rolling over, but it didn't. So it moved into leading, and it's now actually on the weekly scale the strongest sector, again being caught off guard. So what I do like now is the fact that I see that we're now actually pushing above important resistance levels on the weekly chart. So this trend is getting more mature. From a relative point of view, it's still definitely interesting enough to get in there. Or if you want to time it a little bit better, then maybe you want to wait until it curls over, or find on the daily RRG. Well, you probably you probably need to be in there right now, because this is now confirming what we see on the weekly, and we're breaking above resistance. So yeah, I think energy is now definitely on the map as a very interesting sector. The ones that I've been focusing on for the last few weeks is actually this cluster here. There's 3 sectors here that are all making that rotation that we just discussed, coming from leading, and here is communication services, here is discretionary, and here is technology. They will come into the picture in a minute. Communication services moved into lagging very shortly, but then started to curl back up and is now in weakening. And now you see technology and discretionary coming, and they're now all back up. Tech, discretionary, and communication services. Those are the 3 sectors, and they're major sectors in the S&P that I think will lead the market going forward. So these are the ones that I keep an eye on as being very important. Obviously, energy, and you see financials are definitely starting to lead again as well. And we have a setback in materials and industrials. Forget about utilities and staples. Those super defensive sectors, they're way back into lagging. They're lagging the market, and their charts don't look very good. So maybe you want me to go into that sector rotation model stuff that I talked about last week.
Yeah, I mean,
Basically bring that into. Let me bring up that article. It's a good.
yeah, why don't you, I mean, we've got 7 minutes to 11. Why don't you go ahead and take the rest of that and look at, however you want to look at the sectors, and then I'll jump into the small cap area for a bit,
Yeah.
and then we'll wrap things up.
So this is the article. Maybe, well, I'm pretty sure a lot of people are actually familiar with this sector rotation model, which is basically putting the economic cycle, which is the orange line here, which is that sinus wave. You go from a recession to an early recovery, to a full recovery, into an early recession, into a full recession, and then you go, you make that. So you go through those 4 economic phases. And we all know that the stock market or the market is leading the economic cycle by 6 to 9 months roughly. And that's the blue line that you see here. Now, over that economic cycle, you will find certain sectors that perform better during specific phases of the cycle. So what I try to do from time to time is actually try to match what I see on the RRG with the model. So what I did here is I highlighted all the sectors based on the current rotations on the RRG. And the green ones are the ones that I think are doing good, are in relative uptrends. They're outperforming. So that's tech, comms, discretionary. That's the cluster right here. We've got energy, which is right there. And we've got financials. And obviously, because this cycle repeats, financials is actually not at the end, but it is positioned right before discretionary. So you got a very nice cluster of green outperforming cycles, which suggests, based on the sector rotation, that we are currently in a phase somewhere between a full recession and an early recovery. So somewhere here, which is in market terms coming out of a market bottom, going into a bull market, which is for some maybe hard to understand or hard to believe, but you know, a market decline or a bear market doesn't always have to last 5 years and doesn't always have to be 50%. And I think that that's what we have just seen. But there is more to this than just sectors. There's a few macroeconomic variables, and it's probably going to be too long if we bring up all those charts, but just go to stock charts and read that article. You'll find all the charts. And actually, there's a chart list that holds those 4 macroeconomic variables as a chart. The only one that I can't really put my finger on is the consumer expectations. The model says it should be rising, and there are different cases that you can make. Industrial production is rising. Interest rates are bottoming out. Yield curve is definitely rising or steepening, and we're going from normal to normal steep. So that's a steepening curve. That's definitely happening. So all of these elements that make up that sector rotation model suggest that we are somewhere here in terms of economic cycle and therefore in market cycle. And that, the only conclusion that I can draw from this, assuming that all of this is true, because that's the assumption that we are working on, is that there is much more upside for the stock market in place. So that was the short version. I know you want to talk about small caps, so let me do one more thing and before I hand it over to you. And that's the RRG, where we actually look at size indexes. So here we have an RRG that's actually breaking down the Dow Jones US index into large, mid, and small. And what you can see here is that small caps are by far the strongest segment, followed by mid caps, and you see large caps on the left. So again, assuming or knowing, generally accepted, that bull markets are driven by small caps and mid caps and not by large caps, is another sort of piece of the evidence that the market is actually still quite strong. And you see here is the daily. It actually picked up again very recently. We had a very brief period where large cap, so start of February, but it's already turning around again, with small caps and mid caps picking up and large caps lagging. So yeah, lots of pieces of evidence, lots of pieces of the puzzle that point to a continuing strength of the U.S. stock market.
Yeah, I tend to agree with you, Julius. I have been pretty bullish throughout. And your comment about, bear markets not lasting 5 years, I think was an astute one, because you have cyclical bear markets and you have secular bear markets. And of course, the secular bear markets, folks probably remember, 2000, 2003, 2007 to 2009. I mean, we went through a 10, 12-year period where we went nowhere. And, compare that to what we've seen over the last year. I mean, this is completely different. So, when you look back to February, March of 2020, that's a cyclical bear market. It was 35% drop, but it was
This,
in 4
yeah,
weeks.
this piece here. Yeah.
Yeah, I mean, it was crazy, and it was very similar to 1987,
Yep.
market crash, where we didn't come back as fast back then, but, by the time 1989, 1990 rolled around, that 1987 was in the rearview mirror, and the market went on another 10-year tear. So I think psychologically, a lot of folks look at what happened and just cannot, for the life of them, figure out how we can, come back like we have as quickly as we have. But I think what you have to understand is where we were when the pandemic hit. We had, 50-year lows in unemployment. The economy was strengthening. We kind of had all signs were pointing to go on the U.S. stock market and around the globe as well. And so I think that temporarily derailed us, but it was not like it wasn't a financial crisis. It was a healthcare crisis. And so, we were able to come back pretty quickly from that. But I thought that comment was very astute because that was a cyclical bear market that lasted literally 4 to 5 weeks. And now we have been right back at this bull market ever since. And folks are still scratching their head. But I completely agree with you. Not only do I think we're going higher in 2021, I think that this decade is going to be an incredibly strong decade, very similar to the 1990s. And I think that the rest of the decade will be part of a secular bull market. Doesn't mean that we won't have cyclical bear markets from time to time, just like we did, maybe not to the extent that we did back in March, but we'll have 20% corrections or quote unquote bear markets along the way, but they'll be short lived, maybe 90 days, and then you start moving back up again. That's what I expect over the next 10 years.
I'm not I'm not a big fan of overlaying certain periods of the markets because I think you can always find something. But if it just eyeball, because here, this is 10 years before we hit new highs. If you look in the early 70s, and if you look at the market starting, in November 74, all the way up, that includes the crash, that includes massive serious bear markets. But that lasted until 2000. That is 25 years. 25 years of bull market with at least one that is properly labeled as a crash in there. And if we say that that this one in 74 matches this one in 2009, then we still have a little bit of time left.
Yeah. Well, and when you look at 1987, it was a crash, but it doesn't look like a crash now when you look back at it. And I think the same thing will happen for 2020. I think as we get further out, we're not going to be thinking of it as much as a crash. It's not going to look like it on a long-term chart. And that was kind of my point. But I'll go ahead and were you done with this, Julius?
Yes, I am. Go ahead, man.
Okay. All right. I'm going to go ahead and run and take a look. I wrote an article this morning, and it was a rotation to small caps article. And I did this because I knew we were going to be having this discussion and this webinar. And I wanted to walk folks through how I look at the market and how I break it down and how you can use RRG to help in that process. So first chart I gave was just small caps versus the S&P 500. And they had been going down quite a bit for the last few years. But since the vaccine came out in November, we have seen small caps torch the S&P 500 to the upside. Small caps have been crushing the S&P 500, and I think it's going to continue. I think in a bull market, small caps are able to grow much more quickly. I think some of them that were going through some rough times are going to see their earnings rebound very quick, very rapidly, similar to what we saw with many of the pandemic stay-at-home stocks back in March, April, May, when those stocks were leading and they were going up so quickly. I think that's the phase we're in right now. I think small caps are really leading. So I went through and I just showed a very simple RRG where you take the small cap, the S&P 600 small cap, and compare it to the benchmark S&P 500. And this is going back now, quite a ways. It's a long tail, but you can kind of see, and I think you talked about this when it turns back up, it's really still in this clockwise rotation. But I think it's pretty clear now when you see how far out to the right small caps are versus that vertical center line. That shows you how much relative strength. So this is how you see it on the RRG. This is how you see it on a price relative chart. So I just wanted to kind of point that out, that this is how they kind of correlate to one another. Then I went on and I said, okay, well, let's just look at the absolute price chart of the small cap index. And when we saw this right here, this is the last 15 weeks. If you actually counted these, this would be, the tail would be 15, going back here to this center point, all the way through this whole process. Now, if you look back at the chart, and this is what you were alluding to earlier, Julius, you got to combine what you're seeing on RRG with what you're seeing on the absolute price chart. We had multiple tops on the small cap index, June, August, and then again in October. And when we made this breakout in November, this is what you're seeing right here on this RRG. It is exploding in that northeasterly fashion that is so bullish on the RRG charts. Now, it doesn't go on forever. You do have to slow down that momentum at some point. But even as momentum has slowed, relative momentum has slowed, we're getting further and further across away from the center line. Relative strength is not dying. I mean, this is a group that continues to show great relative strength. And again, it gets back to this chart. Okay, so just kind of picture that you've got small caps that are doing so much better than large caps. Everything's going up. I mean, the S&P 500, folks can't realize or can't believe how much the S&P 500 has risen. Well, small caps are crushing the S&P 500. Just keep that in mind. So then I went on and I said, okay, you've got these small cap sectors that you can compare to the small cap index, because if we know small caps are doing well, what are the individual sectors doing in terms of small cap performance within those sectors versus the S&P 600 small cap index? And that's what this is plotting right here. So for instance, PSCE, this is your small cap energy. PSCT, which is right here, starting to strengthen, coming across, that's small cap technology. How about this one? This is the one I really like here. This is PSCD, which is small cap discretionary, which had gone down into that weakening and is turning back up, just like Julius was talking about, where you're in leading, you go down into weakening, and then you rotate back on the right side of the chart, back up into leading. So these are the areas right here that I'm most interested in. If you look over on the left side, this PSCU is your utilities, small cap utilities. PSCC, small cap consumer staples. And then you've got PSCI, small cap industrials, and whatever the other one is. I'm missing one, but anyway, those are over on the left side, and they're quite a bit to the left side, meaning that your relative strength in those areas is not very good. Oh, financials would be the other one over here. So those are areas maybe I wouldn't be overly excited about. Now, what I'm going to do is kind of pick up from where I left off in this article and tell you what I would do with this information. And I even created a product that I'm going to share with our Earnings Beats members. Actually, I made it a public chart list, so anybody can download and look at these charts that I'm going to show you in just a couple minutes. But let me pull up first. Here is that chart that I was showing you, which is all the small cap sector ETFs compared to the small cap S&P 600 small cap index. That's the benchmark. And what I'm going to do is I'm going to rotate this for you since the pandemic. So when we went into the pandemic, I want you to take a look as we got to the bottom here. Look what's leading: small cap utility, small cap consumer staple, small cap healthcare. So there are your three defensive areas leading as we were going down, which makes sense. That doesn't mean that they weren't going down. This doesn't mean that these three you were making money on them. It means that you were just doing better than the overall S&P 600 small cap index. So on a relative basis, you were outperforming. You were still losing a lot of money. Okay, I wanted to clarify that. But once we get to the bottom in March and we start moving higher, I want you to see how the defensive groups turn, and they don't just go to weakening and come roaring back. Watch these three down here, or these three over on the right side. Watch as we continue moving higher. There goes utilities over into the lagging. Healthcare turns up. Let me point out healthcare here. So here's your healthcare. Healthcare still doing okay. Consumer staples, it is now moved left of this center line, this vertical center line. It's now underperforming. And if you look at the utilities, It's really starting to underperform. So do you see what happens as you start moving up? Defensive groups tend to lead. And then as we watch utilities, it just stays over here. This is not a group that you want to be involved in. We're staying on the left side of this chart. So we're not seeing the relative strength. Now let me show you technology and how technology went through this whole process, small cap technology. So when we took the big drop to the downside, technology actually held up pretty well. Think about that for a minute. Everywhere you looked in the media, we were talking about Great Depression 2.0, how this was going to be awful and everybody should, run for the hills. Why would small cap technology still be outperforming and on the right-hand side of this vertical center line if we're heading for Armageddon? Makes no sense. And then as soon as we start moving up, look at PSE. Now it goes briefly over on that left side, but look at it rebound right back over. And now here it is still continuing to strengthen. Now, if we go back and we look at something like energy, and we could go back 3 years. I want you to watch energy. Now, this is small cap energy, but it's all energy. For the last 2 years, watch energy and where it rotates and where it goes. See how it keeps going? It's improving, and then it dies before it can get to the leading. And then it's improving. Wow, look at that. And then it dies. And then it comes back. And now, and I've said recently, this seems like the real deal to me in energy, which if global economies are beginning to strengthen, we've seen crude oil price go through $60 a barrel, although I think maybe we've just drifted back down below that level. But everything to me is starting to line up that, hey, energy is much better now. And this is just the one chart that kind of confirms it. So energy is something that we want to at least be thinking about. I think energy has turned the corner. Now, the one problem I have, and I'm not going to have time to get into it today, is I believe the dollar is going to strengthen in 2021. And if I'm right on that call, on a relative basis, energy, even though I think it will do okay, I don't know on a relative basis if it'll be the leader. So I'm kind of like Julius. I think that the key for me is to follow the technology area, and of course, small caps. I like small caps. And then I like consumer discretionary. Now, they don't have a small cap communication services. So that's included in technology. So, but those are the areas I completely agree. During a secular bull market, and I've written articles that show you that we broke out of the secular bear market, in my opinion, on April 10th, 2013. That's when we took out the highs from 2000 and 2007. Since that time, technology, consumer discretionary, and communication services are by far the best performers, by far, way above the S&P 500. So if you want to outperform the S&P 500 and you agree with me that we're in a secular bull market, then you want to concentrate on these sectors that Julius was talking about. I completely agree with that. And that's what we've been doing with our portfolios, which I'll show you in a minute. But so that's kind of how I would use RRG. Focus for me, again, I want to focus on this side of the chart, and especially on a weekly chart. The daily charts, you can see some pretty crazy moves back and forth short term, but weekly, you'd have to be in some, you'd have to show relative weakness for quite a while to go from being leading to rotating all the way back into the lagging. So that's why I like using these weekly RRGs and concentrating on the right-hand side. Now, next up, this is our model portfolio that I'll show you. Now, this is the 10 stocks that we currently have in the model portfolio, where they were back on November 19th when we selected them. Actually, not quite. Let me go back a couple more. And this is a daily chart, by the way. But these are our 10 model portfolio stocks relative to the S&P 500. Now, a couple things I want you to notice is how far some of these stocks are to the right-hand side. So if you look at a stock like Snap, it's been coming down. At the time we selected it, you might look at the RRG and say, wow, it's really weakening. I wouldn't put that in a model portfolio. But look at how far it was over to the right-hand side and how much relative strength Snap was showing. You can't keep that kind of relative strength up forever. You go through a period of consolidation, and then many times these stocks come roaring back again. And so watch Snap as we go through this quarter. You see what happens there? And it's strengthening again. But it basically stays on the right-hand side of this chart the entire quarter. It's leading. And if you look at all of the chart or all the stocks on here, as I go through this quarter, there's November 20th. That's about when we started the quarter. But most of them are on the right side. A couple have, drifted a little bit. Zoom was the one outlier, but I actually, and 5.9, some of the software stocks were beginning to struggle a little bit in November, and 5.9 had moved down a little bit. But I still, looking at the price chart, I still liked Zoom, and I still like Zoom. Zoom is one of my top holdings. I think Zoom goes much higher from here, personally. I think they're going to have a run into their earnings report. We'll see. But if you look at the RRG alone, and this is where it gets back to another point Julius was making, I wouldn't make my decision solely based on what I'm seeing on an RRG chart. To me, it's doing a lot of homework for me, where I can then take my homework and then go start looking at absolute charts, price charts, to make my decisions on what I want to own, what I don't want to own. But if you watch, most of this rotation on all 10 stocks, most of it remains over on the right side of this vertical center line. So you're constantly, that's the whole idea with leading stocks in leading industry groups. This is kind of the RRG visualization of what we talk about at Earnings Beats, which I think is pretty powerful. Now, the next thing I want to do is, I talked about discretionary, remember, on this RRG discretionary, making this move back up. And, if we kind of follow, actually, let's make the tail a little bit longer here. But you can kind of see the rotation that's taking place, and it's just turning back into the strong leading group. So this looks really good to me. So what I did over on this RRG is I went and researched the PSCD, and I got the top 10 holdings and put them on this particular RRG, and then used the PSCD as the benchmark. So I can look at the 10 stocks that are in this ETF that are starting to look good, and try to zero in on the best stocks within this group. And so again, if you just look recently, you can kind of see where the strength is coming from. You know why this ETF is doing so well. Look at these stocks. Look at how many stocks up here in this leading quadrant. They got a couple down here that I'd probably avoid, but basically this is some really good rotation. Now, the ones that I would be interested in, look at this CPRI. This is way over to the right. The JDK RS ratio here was up to close to 140. You don't see that very often. 140, that's a lot of relative strength. But it's come back down, and on a relative basis, it's moving into the weakening. Maybe this is a time to be thinking about something like this. Or how about Crocs, which has been coming down, still quite a bit over to the right, starting to turn back to the upside. Maybe Crocs is one that we want to, think about. It's starting to curl back up again. But I wanted to just point out, and then we're going to wrap up. I'll show you a chart list that you can access in just a second. But I pulled up CPRI. So this is the chart that's leading the PSCD, which is looking so much better. And now you might get a better sense of what is going on the RRG chart. This stock went from $20 to $45 in 2 months. That's how you get to 140 on that relative strength side of the chart on the RRG. Since then, though, the market keeps going up, and CPRI sideways consolidates. This isn't anything bad. But, those who maybe don't study the RRG or don't understand it might look at this and say, wow, this thing's falling apart. It's not falling apart. It's giving, in my opinion, might be giving us a pretty good opportunity as it consolidates. So this is the type of stock that I would be very interested in. Look at the relative strength down here at the bottom. So here's the group that it's in, which is clothing and accessories. Been going up nicely. Here's CPRI relative to clothing and accessories. It's been going up. It's a leader. Here's CPRI relative to the S&P 500. Been going up, consolidating a bit. And then here's the industry group relative to the S&P 500. Just set a 52-week high about 5-6 weeks ago. It's pulled back a little bit, but this is an area that if it starts to move, you got one of the leaders here. So I would be very interested in a stock like this. And I think that this is a good way to maybe take a look and just keep drilling down. I always talk about our approach being, a top-down approach where we look first at the market. Are we going higher? Are we in a bull market? Are we in a bear market? What should we be looking for? Look at those sectors. What's leading this market? When you see the aggressive groups leading, that is generally a green light. When the market's going up and it's being led by areas that represent risk on, when traders have an appetite for risk and they're putting their money into areas like that to drive the stock market higher, that is a sign of sustainability to me, to the upside. When you've got a few months of leadership coming from defensive groups that's leading the market to the upside, then I'm going to pause and try to maybe take a step back, be objective, and look at what's going on in other areas of the market. But right now I'm seeing a lot of positives in this market. So what I did is I put together this chart list. So I went into all of those small cap, where was it? Back over here. So all of these small cap ETFs, PSCE, PSCT, PSCM, PSCD, all the different sectors. And I went and I looked up the top 10 holdings. And then I put them in this chart list. And the way I numbered these is basically started off with all of the energy stocks starting 001. So all of the 001s are PSCE. And then I've got them further labeled 1, 2, 3, 4, 5, all the way to 10 with the individual stocks and their percentage, the holding within that sector ETF. So I did that for all of these 9 sectors. And there's a reason there's 9 sectors and not 11 is I believe both financials and real estate's combined in one, and technology and communication services combined in one. But I've done this for all of the 9 small cap sector ETFs with the percentages and so forth. And so you could see right now, they're all pretty green right now. Market must be still doing pretty well today. But you could go back and you could change. You say, okay, what have these done over the last week? Let's sort it by percentage change. And maybe the ones at the bottom, well, I don't know about 23%, but maybe some of these that are pulling back, we could add in the scooter and we could add in industry and sector, industry and scooter. And so now we can look at these and say, well, here's a couple of stocks that have pulled back over the last week and they've got scooter scores 92. Another way is just to sort it by scooter. These are the top performing. There's that CPRI. Of all the holdings in all of those small cap sectors, CPRI is the number 1 in terms of scooter, which makes sense. Been a great performer. But then here you can see all the top performers and what they're doing over the last week or what they're doing over, just today, intraday, and see if anything's pulling back. But obviously they're all small caps must be having a really good day because there's a lot of these stocks doing very well today. But anyway, what you can do is if you go to earningsbeats.com right here, we put it on our homepage. Anybody can go in here and click on this. And if I click here, it's going to bring up all the charts. If you're not a Stock Charts member, you can just flip through and look at whatever you're going to have to go through. Basically there's 90 of them. There are going to be 90 charts. So you'd have to go through one at a time. But if you are a member at Stock Charts, extra member or a pro member, if you're basic, I think you only get one chart list. I think it's your default. I don't think you can download someone else's chart list. But if you're an extra member or a pro member, go to earningsbeats.com, click on that link. It'll bring you to this point. Hit this, save to chart list. And now I can just add this as a new list in my account. So I can just say, okay, 999 small cap leaders. I don't know, whatever you want to call it. And save results. Look how fast that was. All the work we do and that I did here, you can load into your account literally in about 2 seconds, maybe 1. So it's a pretty cool feature. And then from there, once you've downloaded it in, and let me go down, where did I put it? 999, here it is. So there's my small cap leaders. And now I can go into view all, I can do the summary. Let me show you one other cool feature. And our members at Earning Beats know quite a bit about this one. But when you go to your dashboard, you might say, and there's small caps, by the way, up almost 2% today. So we are seeing a lot of strength there. You can go down here to scans And watch this, new scan. I'm going to get rid of anything filtered here. And I'm going to say, and I have no idea whether these will, how this is going to work out, but let me go grab that chart list. 999, there it is. I'm going to add it. And then I want to compare to see if any of those small cap stocks are on our strong earnings chart list. So I'll add that, or our strong future earnings chart list. And all these chart lists, by the way, are downloadable for our members who are also Stock Charts members, extra or above. So now what I want to do is look to see if any of these small cap leaders are also in either one of these two chart lists that we create. This is just research that we do. But there are no similar stocks on strong earnings and strong future earnings. There's zero. So if we look for a small cap leader that's on this chart list and on this chart list, it's going to come back with zero. We need an or clause. So what we do is we put in a bracket here, we put in a bracket over here, and now this becomes or instead of and. So now when you read this, the scan engine is going to look at it and say, okay, give me those 90 stocks that are on the small cap leaders chart list, and give me any of the stocks that are similar that are on either the strong earnings or the strong future earnings. Now, I haven't run this, so I have no idea. All right, the syntax is fine. We run the scan, and 27 of them. So 27 of the 90, we've already done our research and said these are good stocks. And now we know which 27 they are. And we've sorted by scooter, sorted by sector, sorted by industry. You might be looking at this thing and saying, I'm really into technology. I want to look at the small cap semiconductors that are doing well and are included in these ETFs. And there they are. And the highest scooter one is Brooks Automation, which, by the way, I own, full disclosure. But it came down, tested its 20-day. This has been a great stock within the semis. Semis going up. Look at Brooks relative to the semis, and then semis relative to the S&P 500. This is how you can quickly filter down to some of the best stocks. And this is what we do at Earnings Beats. We have a research platform, and it's basically research and educational platform. That's what I like to refer to it as. And if you go back over and while you're at Earnings Beats, let me type this in. So while you're over at the homepage, again, there's your link. But check out our portfolio performance. We're going to be announcing the stocks on Sunday night, and the free newsletter won't get you in, but a no-cost 30-day trial will. So if you're interested and you want to come in and listen to the 40 stocks that we're putting into our portfolios on Sunday night, just hit that Join Today button. You'll be charged $7. We'll refund you that within a week. So you're going to have a zero-cost 30-day trial, and you'll get all these stocks for the portfolios. And the results here have been pretty stunning. I mean, you can see model portfolio up 29% this quarter. S&P 500 is up 9%. For the 2 years and 3 months that we've had the model portfolio, it's up 244%. S&P is up 45, 46. And it gets back to exactly what Julius and I have been talking about today. Stick with those areas that are leading in the market, leading stocks and leading industry groups and leading sectors. That's your recipe for success. All right, Julius, I'm going to go in and look at some questions. Why don't you go ahead and take the screen, because I know that there were some questions for you that I want you to take a look at.
Yeah, I've actually, while you were talking, I've been trying to multitask. So I've already answered a lot of questions in the chat.
Okay.
And while I was doing that, I saw you doing that stuff with the small caps, and I was stunned. That is exactly how RRG is meant to be used. And I'm actually going to put that small cap universe as a drop down, because I think that's awesome.
Yeah.
That's just one more level of granularity that we can have and that we can just bring up. So yeah, so basically you probably have that chart saved as a bookmark, or at least I hope you did, that you don't have to punch in those ticker symbols every time. Maybe that's interesting for people to know who are Stock Charts members, that you cannot save an RRG chart like a normal sharp chart and put it in a chart list, but you can save an RRG that you have just set up, like the one that Tom's now showing. If you scroll all the way down to the bottom, there is a permalink. So if you take that permalink and save that as a bookmark in your browser, you can just click that bookmark and bring it up. Just like you save a website as a bookmark, you can save that RRG as a bookmark.
Okay.
So that saves you a lot of work when you want to set up a customized RRG with your own stuff. Or, you have that those portfolios. You could set up those portfolios in an RRG and save it, and just quickly look at it every day or every week or whenever you like, without having to punch in all those ticker symbols again.
Yeah. Yeah. And all of these, and all of this is included. For instance, if I go over here, I've got all of these portfolios. There we go. With the stocks in them. And these can be downloaded by our members as well. So we've probably got 11 or 12 chart lists that our members can download directly into their accounts. So we do a lot of research. For instance, probably the biggest one is our strong earnings chart list, which right now has 400 companies on it. And these are companies that would have beaten Wall Street estimates, both revenue and earnings per share. They're liquid. So I make sure that the volume is such, I don't want to put a stock in here that trades 3,000 shares a day. So they should be all trading at least, 100 and probably 200 to 250,000 shares a day or more. And they're also something I like about them technically. Either I like the individual stock, or maybe I like the sector or industry group that the stock is in. And it may not be a leader right now, but maybe it could be. And so I want to kind of keep track of that. But when you look at this chart list, and we view it in summary form here, you will see that, actually, let's do it in edit form. So that'll tell me how many we have. We have 400 right now on this chart list. And then you can bring it back to summary form and look at it on a percentage change basis, whatever. And you can see the stocks that are leading. Actually, Digital Turbine, APPS, which had pulled back recently, having a pretty big day back to the upside. Enphase, really strong day. That was my bad luck. Literally, I was trying to buy Enphase at 4 o'clock yesterday, and I got shut out by about 2 seconds. I'll show you that chart. I'm kicking myself. But look at this test of support and this gap support right here. So I had already looked at this, and that's the other thing I do is I put annotations on these charts so you can kind of quickly look at a couple of key areas of support. So that was a recent low, and then you can see this other low down here. So I kind of looked at 170 to 180 as being a nice support area, and we printed a nice hammer off of it. And I tried to buy it at the close and missed, and now missed out on 7% move. That's how frustrating trading can be sometimes. But anyway, but these chart lists are pretty cool. So if you do try us out for 30 days, you can download all the chart list if you're a Stock Charts member, extra or above, and take all of our research in for the next 30 days and see what happens with your trading. I think you'll really enjoy it. Anyway, all right. Well, if there are no other questions, and I'm going to just pull this up and see if I have anything else. No, it looks like you got them all. So I think we're good to go. One last question was on outlook on semiconductors and NASDAQ. I mean, I'm a fan. I think semiconductors are awesome. We put a semiconductor in each of our 4 portfolios for the last few quarters, maybe the last several quarters, and I'm sure we'll do it again on Sunday. We'll look to find what we think are 4 of the best semiconductors, and they will each be in one of our 4 portfolios. I'm a huge fan of semiconductors, and relative strength will bear me out on that. I'm sure the RRG chart would show you semiconductors as one of the leading industry groups as well. But anyway, it was great having you on here today, Julius. I really appreciate you taking the time. I know it's probably your dinner time there, so I'm going to let you go.
Almost.
Awesome.
No problem. No, I really enjoy it, Tom. I always do. And thank you so much for having me. And hopefully people liked it. So there you go.
Yeah, let's let this bull market carry on for another couple months, and hopefully you'll have some time. You'll come back and join us again.
Most definitely. I'll make time for that.
Awesome. Thanks again, Julius. And thanks to everybody for stopping by. Really appreciate it. Hope you enjoyed the presentation. And again, give us a shot over at Earnings Beats. We'd love to have you. Take care, everybody. Happy trading.